Thanks for joining today's session on Real Estate Experts, Conversations with Chima. Our guest speaker today is Williamson with Meridian Bank. Today's episode is going to be very technical, guys. So this is one you should take time, grab your cup of coffee, and listen through, because it's absolutely crucial that you understand the mortgage industry and understand what a mortgage is, especially when you're trying to buy a house. We're going to talk about first-time buyer program mortgages. We're going to talk about jumbo and high-end mortgages. We're going to talk about the type of loans that are out there for if you need assistance with closing. We'll talk about everything, lender credit, how to get money from the seller if need be, and if that's possible in a market like we have, that's a seller's market. So that said, Williamson with Meridian Bank, thanks for joining, and stage is yours. Please tell us, Kelly, first of all, how's your day?
Good, thank you, Chima. Thanks for the introduction. It's a pleasure and honor to be here to, give this information to prospective buyers and sellers and people who just want to know about our industry. Yes.
Yeah, Kelly's my brother. We've been working together for so long, and it's my brother from another mother, and we are in this, together to really bring as much information. So guys, these episodes are for you to get as much information. We actually do counseling classes together for first-time home buyers. And, it's a joy for us to do this, to give you as much information as possible. So you're empowered, whether it's in 6 months, in 1 year, in 2 years, in 5 years, Lord willing that we're still here in this business. We're here to be able to answer any questions, and we're going to keep putting out more of these episodes so that we can educate the community as best as we can. Thanks, Kelly. So with that, what is your experience in this industry, Kelly? Tell the audience your mortgage experience.
Yeah, so Chima, I've been in the business going on 24 years. I've held different capacities from originator, a newbie to manager, and now I'm considered a senior loan officer, and I specialize in all different loans. So that's where my experience is. I've been with Meridian Bank now for a month. Previously, I was with another firm for 10 years, so I'm very loyal, but I have a great opportunity at Meridian to help with buyers and sellers and
yes.
real estate.
And we talked about that. We talked about how the opportunity with the programs that are available for you at Meridian. That's one of the reasons that you made that switch. And if you can let the listeners know what is, so we're just starting from scratch. What is that? So I'm a newbie. As a buyer, most buyers don't have conversations on a regular basis like you and I about mortgages, and so they don't know what a mortgage note is. And so if you can let the audience, the viewers know, what is a mortgage note?
Sure. A mortgage note is simply an agreement between the bank and the borrower that the bank is going to lend you a certain amount of money at a certain interest rate over a certain period of time. So it's considered like a promissory note that indicates, okay, how much you're going to pay, again, over a certain amount of time with a certain interest rate. So that's what a note is. It's just basically a promissory agreement. I promise to pay. You give me the money, you loan me the money, I promise to pay you back.
Nice. And what types of loans are there? Because I know there's FHA, and what other types of mortgages are there available to the consumer?
Yeah, so there are three entities. You have FHA, VA, and conventional. Conventional is broken up into Fannie Mae and Freddie Mac. FHA is typically tailored towards your first-time home buyers. It's a little bit more lenient with credit and situations you may have had in the past, bankruptcy, a judgment, collections, things of that nature. But the FHA allows you to get your situation back on track. Conventional is not as lenient; it's a little more strict. Typically, conventional loans are for people who want to put a little bit more money down, who have a little bit better credit with credit scores and things of that nature. And then VA is strictly for veterans. So veterans have the ability to purchase with no money down, and the seller can pay all of the closing costs. So, veterans are tailored towards that program. FHA clients are going to be tailored toward, they work really, really well with the programs that are available today as well.
Gotcha. So most of your first-time home buyers are going to be using FHA. Are they conventional products? Because as a real estate agent, we have, when we write contracts, especially in this type of market, it's a seller's market, a lot of other agents are looking for that conventional loan because of the points that you made. It's a stricter loan. It means that the buyer is probably more qualified in some cases, not all cases. And so are they also programs or loan types for conventional loans that first-time buyers can use?
Absolutely. There are some first-time home buyer programs and incentives that you can also use with conventional financing. Conventional financing also has a 3% down that we offer at Meridian Bank that works really, really well. You have certain income guidelines you have to meet and certain other criteria, but it does still work very well with first-time home buyers as well. With the market that you're in, where sellers want to lend or they want to sell to someone who has conventional financing, is primarily because of the appraisal conditions. So a lot of times with conventional, you may not have as strict guidelines with the property itself versus FHA or VA, which are backed by the government.
And so there are more conditions that the FHA and VA require on the property than a conventional loan would.
Yeah, it's not much. I mean, what we look for in a property, we want to make sure it doesn't have standing water in the basement. That's both for FHA and conventional. You typically don't want to see chip and paint. You want to make sure the roof is secure. But conventional, you do have a little bit more leeway with those type of conditions.
Gotcha. So we've talked about first-time buyers. What about, because some of my listeners here are buying houses, $800,000, $1 million, 1.2. What loans are available for them?
So there are conforming limits that have a cap, and each county has one. So if you go above that cap, then you're considered into a non-conforming type of loan. So non-conforming is synonymous to jumbo or higher price loans. So what that means is the guidelines are going to be a little bit more strict. You're going to have to have a little bit more money to put down, and also reserves. So when you buy a jumbo house, or something that's over the conforming limits, then the guidelines get a little bit more stringent in terms of the money, the skin that you have in the down payment, and having money left over after you go to settle.
Okay. So guidelines, like you said that several times. Guidelines. What are guidelines that first-time buyer, move-up buyer, high-end buyer? What are those guidelines that you look for as a lender?
Yeah. So every loan has guidelines. So for instance, just to give you an example, right now with FHA, because of COVID, a lot of lenders are taking a little bit more conservative approach. So one of the guidelines is we have a minimum credit score requirement. Most companies are going to be at least 620, some 640, some 660, and very few are going to be below that. So
is that FHA or is that all loans?
Sorry, that's FHA. Okay. And even the companies now, because of COVID, they may have a credit score minimum across the board for every program. So that would be VA, conventional, and FHA. Okay. So each one of those programs have different guidelines that have to be met. There's a ratio guideline for each program. And what that means is the ratio between your gross pay versus the liabilities that you have on your credit report. And it has to be a certain percentage to meet that guideline. So those are important. The credit scores, the ratios.
So the credit score, one, is one of the criteria that they look at, that you guys look at. And there's your ratios based on the expenses you have on your credit report, the monthly minimum. Is that correct?
Correct. Yes, that's correct. Good.
So the monthly minimum expenses. So if I have a credit card and I owe, say, $7,000, but my minimum payment is $45, that's what you're taking, that's what you're putting against me on the ratio end, right?
Correct.
Okay. And so, and it's only, so what about BGE, like my gas and electric bill, or what about, things like that, my water bill, is that taken into consideration?
Well, we don't take in consideration that for the ratio requirement, but we know that it does exist. So, when you go get pre-approved from a lender, they're going to tell you the maximum that you qualify for based off of your gross income and based off of the liabilities on your credit report. But you have to remember, everything, your budget is based off of your net income. So if I can give you any advice, you create, create a budget with your net income, which you're bringing home every week, excuse me, and you want to look at bills outside of what's on your credit report, like BG&E, like your cable bill, your phone bill, groceries, shopping, nails, hair, etc. And then once you figure out what you're bringing in monthly and what you're paying out monthly, including what's on the credit report, then you have a surplus. And that surplus is going to be your amount of money left over for your housing. But then included in that, you're going to have other things that come up that cost money too. So you have to be prepared, because you're not renting anymore. You have to be prepared if there's any type of electrical problem or plumbing incidents that happen, that you're going to have to pay for it out of pocket. So, it's always good to have a couple credit cards that have some money on it, but it's also good to have some cash reserves as well.
Absolutely.
For rainy days.
Absolutely. So I hope you guys are listening. I hope we haven't lost you. I know, like I said in the beginning, this is a technical episode where we're really going deep about mortgages, but you have to understand what you're getting into. I'm of a belief that if you understand what you're getting into, you understand the journey, then the destination is even more fruitful. If you understand that you're not just pushed along the way and get to your destination, you never experience what went on through the process, then you miss out. So even something as simple as, or as complex as mortgages, depending on how you look at it, if you just at least take some time to understand what you're getting into, you're going to be in that house much longer, right? You're going to be in the house much longer. And that's a good segue, Kelly, to what based on all these loans, which one, why should I pick, the FHA? And I know we talked about this offline in regards to, there's a 15-year mortgage, a 30-year mortgage, and then many other types of mortgages, if you can just break those down, and why as a buyer, what makes me pick one over the other?
Okay. As a good lender, there are going to be some questions that we ask you, all right, to kind of qualify you in terms of what you're looking for. So you have your desires, you have your wish list, you have a certain amount of money that you make, you have a certain amount of money that you want to have left over. So, some qualifying questions are, what is your maximum mortgage payment threshold? All right. I want to know that. I want to know where you want to live, because I know what the taxes are typically in each jurisdiction. I like to know what price range of houses have you been looking at? Which ones are you most attracted to? So I get all that information up front, right? But then to start the process, I have to pull your credit, right? Once I pull your credit, I want to make sure that your credit score is where it needs to be to move forward to the next step. If it's not where it needs to be, I'm going to give you simple instructions on how to improve your credit profile and your score. And then once we get through that, I'm going to determine what your debt to income ratio is. So that being said, I'm going to ask for a lot of things. I'm going to ask for your pay stubs for the last 2 weeks. Last 30 days. I'm going to ask for your bank statements to see what your asset position is. I'm going to ask to see if you have any reserve money, like a 401k or things of that nature. And sometimes we may ask for your tax returns and we're going to always ask for your W-2s. And then sometimes we're going to ask for your tax returns. And if you're self-employed, they might be business returns and personal returns. Once I get all that information, I can issue you out a comprehensive and thorough analysis of what options are best for you. And then I roll them out to you. And then we, dialogue back and forth and try to figure out what options are going to be the most attractive, which ones are going to fit your needs. And there are options out there. So there's not just one option. There are many options, and we're going to help you figure out which one is best for you.
Yeah. So we talked about guidelines earlier about what the buyer needs to qualify for a mortgage, and we focused on the credit report. Any other things? When we talked about liabilities, we talked about credit report. Is there anything else as a buyer before I come to meet with you that I should be focused on? What should I, what apart from my debt and my income, is there anything else that I should be looking out for before I come to meet with the lender?
Sure. There are a couple recommendations. When you come meet with me, I'm the person that is going to, obviously pull your credit, take a look to make sure your credit score is where it needs to be, and the credit profile. If you have collections, judgments, bankruptcies, and things of that nature, that's okay. A lot of people do. My job is to tell you how to manage those and to get them resolved, and basically in a position where we can, not only take an application, but get it approved and closed and make you a homeowner. Does that cover what you asked?
It does. And in terms of savings, as a buyer, what should if I'm a buyer looking to buy a house, how much money should I be looking to save or to have? And do I need everything? If we can talk a little bit about that, in terms of buying a house. So let's say I'm buying a house that's $500,000. How much do I need?
Good question. So it really depends. I mean, on FHA, the minimum is 3.5%. So 3.5% times 500,000 is your down payment. On a $500,000 house, closing costs on FHA is typically going to be somewhere around 3.5% to 4%. On the conventional side, you can get in, some programs are at least 3%. So that's 3% down, probably another 3% for closing costs. On VA is 0% down. My rule of thumb is for people who are looking to embark on home ownership is save up as much money as you can. I mean, before the process starts, start figuring out what things you can cut out your the expenses that you can cut out. Want to put yourself in the best position, and having good credit and having your own money is paramount. Now we can get you incentive programs and first-time home buyer programs. We can give you lender credits. So there are some other things that we can do to help you get to that point. And even the seller can help you with seller help. But it's always good to have your own money. So if you don't get seller help, or if you don't qualify for programs, you have your own. But more than likely, you're going to get some assistance, either from the lender, the seller, or some programs.
Yeah. And in this market, as we've been talking about, this market being a very strong seller's market, the more you can save, the better position you're going to put yourself in the long run, correct?
Correct. So, and another thing we look at, we put every loan through what's called an automated underwriting system. So two of the things that are paramount is how much money you're going to have left over after settlement, okay, and how strong your debt to income ratio is. So, with respect to your debt to income ratio, try to have a conservative attitude towards the liabilities that you have on your credit report. Try to pay those down as best you can. In terms of improving your credit, I can give you a couple tidbits on that. If you pay a debt all the way off to zero, you're not going to get the credit improvement as if you keep a low balance and you're paying it on time. You want to try to keep your utilization rate. So what that means is if you have a high balance of $1,000, you want to keep that balance under $300. That's going to help you as well. If you have collections or charge-offs or judgments, you want to try to get those resolved. And if they're not resolved, that's fine. When we pull your credit, we'll tell you the things that you need to work on or the things that need to be resolved, so that you spend your money effectively and wisely, as opposed to just, expending it, spending the money out of the blind, not knowing if it's going to help you the most.
Exactly. And some folks think that you have to pay off a particular debt. So let's say you do have a collection, but we've done it where once they come on board and you pull their credit and you see that they do have this collection, and if they can get some kind of a settlement, even if it's like a monthly payment towards that debt, they still can qualify, correct?
That does help. Now, you can't have collections and then, the other bills are being paid late. So another thing I didn't really hone in on is, underwriters, we want to see that the banks want to see that you have made a good earnest effort to pay everything on time. Now you can have a couple late payments, 30-day late payments. I mean, I missed the payment, it was a hiccup, but the majority of the profile has to be positive. All right. So the more positive it is, you may get away with having an open collection, or sometimes even an open charge off if the rest of your credit is still, above board.
Okay.
It's still desirable. So
what if I have no credit?
Well, unfortunately, in the past, no credit wasn't a problem. You could purchase with alternative credit, and that was having a good rent history that we can verify, having a good BG&E credit history, et cetera, et cetera. We used to be able to do that. Now, because of COVID, a lot of banks and investors, you definitely have to have a credit score, and you have to have credit. So typically what we want to see is at least 3 forms of credit that have been, 2 to 3 forms of credit that you've had for at least 12 months.
Okay.
If you're paying rent, that helps. We can still use rent. And if you're paying rent, pay with a money trail. So if it's coming out of your bank account, make sure that we can get, 12 months, a 12-month history that shows that it's come out of your bank account. If you're paying by cash, I would probably, switch that up and pay it by either money order, something that you can show that the money's coming out of your account to pay it. So that's real important. If you have limited credit, there's nothing wrong with that, but you still have to have some credit, something the underwriter can hang their hat on.
Some history
Correct.
Showing that you're responsible. Yeah.
Yes.
Yeah, cool. So we talked about COVID, and so how in this market, in this COVID atmosphere, what's going on in the mortgage industry? How is it affecting loans? How is it affecting home buyers? What have you found, and what recommendations can you give to buyers, especially in this particular environment that we're in right now?
Yeah, so COVID has affected self-employed borrowers the most. So with self-employed borrowers, we want to see if you've had an issue, if you've had some downturn because you're not getting the same amount of business. Unfortunately, it's going to have a negative effect. However, if you've recovered from it, and we can see that you've recovered from it, and each case is different, then there are certain parameters that you have to meet. There are certain guidelines and overlays that weren't there before. You may have to show, if you're self-employed, you may have to show the income coming into your bank statement just to show that you're still getting that revenue. If there's a person who was laid off, and a person who was let go, from lack of better words, and you're getting unemployment. Unfortunately, we can't use unemployment because you don't have a history of it prior to that. So unfortunately, if you've been laid off, COVID has affected those potential people who were at one time good candidates. If you were affected and now you're back to work, and you're solid, and you had if the employer indicates that that your job is solid, we may have to do a verification to get different points of emphasis from your employer, and that wouldn't hurt you as much. But COVID has affected the business, to a degree where it's become a little bit more strict. We want to make sure that you have the ability to pay. With the CARE Act that came out probably sometime in March, it gave buyers the ability to not make their payments, and they went into a forbearance. But what they didn't tell you is that if you're already a homeowner and you're not paying your mortgage, it does have an effect with the lenders, even though they're giving you that grace period to pay.
It still comes back to bite you.
If you're trying to purchase another property.
Exactly. Yeah. So what recommendations in closing? What recommendations, what advice, what suggestions can you give our listeners who are in the process of buying a home, or who are thinking of buying a home, about to get a mortgage, thinking of getting a mortgage in a year or 2 years from now? What advice can you give them?
So there's a few that come to mind. So when you're looking for a lender, it's always good to, at least consider the lender that your realtor has a relationship with. If you have a good friend, a family member, coworker who's had a good experience with a lender, it's not a bad idea to contact them. At least have two, so that you can compare. I say that because I know that if you call me and talk to me, I think I'm gonna woo you with what I can offer you. I can promise you and make you a commitment what type of service I can give.
He can, guys.
Thank you. Yeah. The other thing is, there are home ownership counseling agencies all throughout the city. And, we can provide that list to you. It might not be a bad idea to go to one of those as well. You'll sit in with a class, or you'll do a Zoom call, or you may even do a course online. And then you'll actually talk to a counselor and do like a one-on-one session, whether Zoom, over the phone, et cetera, that will hone in on the different intricacies of the loan and, their recommendations and things of that nature. So it's not a bad idea to consider that as well.
Yeah.
Pay your bills on time. If you had some issues in the past, they can be fixed. You can change your profile by paying everything on time, by maybe going to Credit Karma and having the ability of pulling your own credit, so you can monitor that.
Yeah.
Your collections and judgments and charge-offs, work on getting those resolved. If you can't pay them all at one time, get a payment plan, stick to the payment plan, pay it on time, and we can also use that as an alternative form to show that you're making the effort to pay it.
Yeah.
And then last but not least, be honest with the professionals that are trying to help you. We're gonna be honest and transparent with you. And for the deal to go smoothly, you have to be honest and transparent with us. Everybody who's trying to help you. If you're not honest, it will come out. It'll come out at some point, and it could be potentially, damaging to the loan. So be brutally honest.
What's an example of a buyer not being honest to a lender?
All right. I have a situation right now where the borrower took time off, right, and didn't tell me. So I had him approved with his bonus income and overtime income, but he took a month leave. And with the month leave, we can't use bonus and overtime because you're not physically employed at the time. So it created an issue. However, the borrower did go back to work a couple of days ago. So we had to, we're not going to meet our settlement date because of this. And again, he wasn't honest and transparent with us. So just the littlest things you have to disclose, because
ahead of time,
or even during the process too. So if something changes, if you lose, and I've had other situations where I've had a person lose their job 2 days prior to settlement, and we're going to call, every lender is going to call the day before or 2 days before to make sure you're still gainfully employed. So, that was another situation where, it really wasn't much I could do, but, this person had the ability of waiting till after he went to settlement to resign, but he resigned 2 days prior to. And, another example of not being honest and transparent. There are a lot of different things, but, at the end of the day, we're all human.
Yes.
We can only help you best when we have all the cards in front of us.
The whole picture.
We have the whole picture, and most things can be fixed. There's typically a solution to everything, whether it's heavy or light. But at the end of the day, we're here our responsibility is to help you have a less stressful process and an informative process. And we're on display. We're using you as our resume so that you refer us other business and refer your friends and family. We want to be your guy. If you hear somebody talking about, hey, I'm looking for a house, you want to say, hey, look, I got a guy for you. I got a guy who's going to, be your realtor and do X, Y, and Z. And then I have a money guy. I got a guy that has money, man. He has first-time home buyer programs. He's easy to work with. You want to have that in your corner. So, be honest and transparent. We're going to be honest and transparent with you every step of the way.
Yeah. Thank you, Kelly. And I hope you all have been listening. I hope you're still here with us. And if you missed any part of this recording, if you go back to the YouTube channel, you're going to see this and you'll see many more episodes. Go ahead and subscribe because there are going to be more episodes with myself and Kelly. There'll be more episodes with myself and other real estate experts in this industry. That's it. That's what we have for you guys. Kelly, any last words?
I wish you all the best. If you have any other questions or you want additional information, please reach out to Chima. He'll provide you with more information.
And actually, if you go ahead, how can they reach you, Kelly? How
Sure.
Website, email?
Yep, the best way to reach me is you can reach me on my office cell phone. The number is 410-365-3773. And my email is kwilliamson@meridianbanker.com.
And I'm going to add that to the comment section below. So if you have any questions, again, this isn't for us to try to convince you on any path, but just to give you the information for you to choose which path you want to go. Like Kelly had mentioned, there's so many different types of programs. So it's once you have that, once you have all the tools, then you can decide which tool do I really want to use. And so if you have questions in regards to the tools, in regards to how this whole process works, please shoot me an email, leave the comments in the comment section below, reach out to Kelly. We are here for you guys. Thanks again, Kelly. Thank you very much.
Thank you again. Yep. Knowledge is power. We have the knowledge. We can give you the power.
Yes. Thank you.